In this video, we'll look at trading crypto options, and we're going to keep everything very simple to simply taking the position and then the outcomes that we can expect. So what are the risks that we're taking and what are the potential rewards? Crypto options can be very complex. I'll leave a video below going over options much more in depth, explaining exactly what they are. So if you want to know more, definitely watch that video. But what we're going to do simply is look at, if we actually go ahead and trade, what are the outcomes we can expect from the trade? So I'm going to be using Bybit for the options trading here. Also OKX I trade on as well. A very good platform for very simple options as well. I'll leave links below to all of the exchanges I use. You can get deposit and trading bonuses if you're new, especially trading options as well. So definitely take advantage of that by the links below. The first type of options trades that we're going to look at is buying the option to do something in the future. What can you do in the future with Bitcoin? You can either buy or sell it. So what we're doing is spending some money for the option to either buy or sell Bitcoin in the future. And if the price moves around, we can either make money or we just lose our cash. So firstly, what we're going to do is buy the option to buy Bitcoin in the future. So this is a bullish trade because usually what you're doing is buying the option to buy Bitcoin at a slightly higher price than it currently is. And the reason being is that you want that option because if the price then moves higher than that, you make money because you can buy at this set price and the Bitcoin price is higher, so you can just take in whatever the difference is. The reason why we buy options here instead of just buying in the spot market is because options are a very cheap way to take a position. So when you buy an option, you only have to put a very small amount down, which means you're essentially taking leverage. You put the premium in, you put the cash in to buy the option. If it goes south and you lose money, you only lose your options premium. That's all you can lose is the amount that you pay for the premium. But because you're putting a small amount down, it's like leverage. So if you actually get a payoff and the price does rise for buying a call option, then the amount of money you make versus how much you put down can be very big. So it's a cheap way to express your opinion about the price rising. So what we're going to be doing is buying the option to buy it in the future. So here's how it works. Let's say the Bitcoin price is 100,000 right now. We think the price is going to 102,000. So what we're going to do is go out into the market and buy the option to buy at 101,000, right? So we're going to buy the option from someone else to buy their Bitcoin at 101,000 in the future. In order to buy that option from them, we have to pay them for that privilege, right? And so that's the premium that we pay. So let's say we pay them $100 and the Bitcoin price right now is 100,000. We're going to pay them $100 and say, in the future, I want the option to buy your Bitcoin at 101,000. Now, if in the future the price of Bitcoin is 102,000, we make money. The reason being, we can always buy Bitcoin from them at 101,000 and we can sell it immediately in the market at 102,000. So we make $1,000 profit. However, we paid them the premium, which is $100. We don't get that back. They always receive that. So our total profit, if this works out, is $900, which is the difference between what we can buy Bitcoin at with our option and what we can sell it at immediately in the market, minus the premium that we paid, right? So $1,000 minus 100 is $900 payoff. So what we're doing here is spending a small amount of cash to take a bullish trade. It's kind of like taking leverage where you can put a small amount down, and if you get the payoff, you start making a lot of money. So what we can do is go to a platform and trade this. Now I'll use Bybit here to show you. Bybit have a very good simple options trading platform. They also have a more professional version here, which we're not going to get to in this video. Like I said, I'll leave links below to Bybit, OKX, the other exchanges I use. They give very good deposit bonuses, especially when you're trading options. So you can check out the links below for all of the deposit bonuses. But we're going to go ahead and buy a call. So what you want to do with buying a call is usually with these options, the call will be above the current price, right? No one's going to give you the option to buy a Bitcoin at below the current price, right? Because why would you do that, right? You just go and buy it, or they're not going to sell it to you, lower price than it currently trading at. Now, some options are in the money because the price moves around a lot. So maybe there are some options that are in the money, but you're going to have to pay a very high premium for that anyway. In any case, that's too complex, right? We're going to go simple. So really, when you're buying call options, most of them are going to be out the money, meaning that the current price is 100,000. They're all going to be more expensive than that, right? 101, 102, 103, and you're looking to buy and actually for the price to move up. So what you want to be doing is buying above the current price. So this one right here, we can see BTC above. That means it's a call option, right? We're buying that. So we're going to go ahead and buy. Now we're spending our cash and we get the payoff if the price rises. So you trade contracts here. So you can see the market price is $110 per contract. So one contract is like $110. So we always pay that premium. We never get that back. So what you can see is the max loss for buying a call option is literally just the premium that we pay. So we pay them 100 and that's it. We always lose that no matter what. If the price is, because the Bitcoin call option is 105,500, right? That's 105,500 plus the call option premium that we pay. That's our break-even point. It's the call option price plus the premium that we pay. That is our break-even. That is our cost always before we actually start making money. Anything below that, basically we lose money because the option expires worthless for us. We won't call the option. It's basically, there's the premium. It didn't work out for us and we lose our premium only. However, if it starts moving above that, right, the call options price plus the premium that we pay, then you start making profit. And with a call option, the max profit is potentially unlimited because the price can rise forever. It's not going to within a short time frame, but you can make more and more and more as the price rises. And you can see that you're taking effective leverage here because you're putting a small amount down, potentially for a payoff to essentially buy large amounts of Bitcoin. Because on Bybit and other crypto exchanges, options are cash settled, which means, let's say when the option expires, the target price is met, which is 106,000. What it's going to do is immediately buy and sell and basically give you the cash back, right, straight away. So you don't have to buy and sell. You don't have to take delivery of the Bitcoin or anything. They just cash settle when the option expires. So that's a cool option. You're spending money. You're buying the option to buy at a higher price usually. If the option fails and the price doesn't rise, we only lose our premium. But if the price rises, then essentially we start making money and we get that cash settled when the option expires. The other side of that is actually buying the option to sell Bitcoin in the future. The reason being is that you think the Bitcoin price is going to fall. So if you think the price is going to fall down very low and you have the option to sell at a higher price, then you can take the difference, right? So we're paying some cash to sell at this price in the future. If the Bitcoin price falls below that, then we can buy low and sell at this price and lock that profit in. So again, just like a put, you have to spend some cash. So we're going to be spending cash, and that premium is all that we pay out. We never get that back, but we're going to spend some cash in order to sell Bitcoin in the future. So let's say the current Bitcoin price is 100,000. We are going to buy an option to sell Bitcoin at 99,000 in the future. We are going to spend $100 for that option. Let's say that in the future, the Bitcoin price is 98,000. We can buy at 98, immediately sell back to the other guy at 99 and lock in that $1,000 profit, minus the $100 premium that we paid, we make $900. So why would you buy a put? You're spending some cash because you think the price is going to go lower, and if it does, you get the payoff. If it doesn't, that cash that you spent, you never get back. That's just it. So what we're going to look for here is below the current price. You want to see something like Bitcoin below or Ethereum below. You can see that here. These are puts. You can see that as well right here where it says P, right? It's actually a put. And this is C, which is actually a call, right? So a call is the right to buy. Put is the right to sell. So we're going to look for, you can see here, this is Bitcoin USDT, 4th of June 25 expiry, 105,000 is the price, it's a put. So we buy that. We know that we're buying the right to buy. We're buying the right to sell, Bitcoin at 105,000. So as you can see here, anything above this, if Bitcoin doesn't go below 105,000, then of course we're not going to sell higher than that, right? Because the price is higher, right? So we need to sell 105 and buy 104. If the price is 106, we're not going to buy 106 and sell 105, right? So we're buying the right to sell at 105. We want the price to come down. And as you can see here, if it doesn't, then we just lose our premium. The max loss is whatever it costs us, $38 for this contract. Right, so if you have two contracts, $76, max loss $76 if the price doesn't come down. If the price comes down, that's our break even, which is the expiry price plus our premium. If it comes down past that, we start making profit. Right, so you're looking to spend a little bit of cash. You think the price is going to come down below this, and then if it does, then you start making profit. The main thing with buying puts and calls is we need to know what is the price at which we break even. And then you can figure out if you think the price is going to get there, you can go ahead and take the option. If the option is too expensive or you think it's too high and the price actually won't get to there, then there's no point buying the option in the first place, right? So I'll show you on OKX. Again, this is their simple version. there is a more complex version here. If you go to options, you can see options here and then simple options. I'm in simple options. If you want to get more in-depth, I've got lots of in-depth videos that you can look at. We're going to keep it simple here. And very simply on OKX, you're looking at buying puts and calls here. Buying the option to buy, calls, buying the option to sell, puts. So I think the BTC price will rise. Well, that means we're buying calls because we want the price to rise. So let's select the target price of, let's say, 107. And it says, yeah, buying a call, that's what we're doing. We're buying the right to buy in the future. You can see the break-even price is 106,000. So take the current price of Bitcoin, put in all of your premiums and costs and everything like that, and the break-even price is some price above that. Do you think that when the option expires, whenever that is, you can see the option expiry dates here. So this is, a couple of months ahead or whatever. If there is even an option, there isn't options here. So this is the only option we can buy, which is a few days in the future. If you think within that few days, the price can't get to this price, the break-even price, then don't buy the option, right? If you think it can, buy the option, and you can see the estimated P&L, if it gets to break-even or above, is obviously pretty good because it's like taking leverage. You're putting a small amount down for potentially big payoff in the future. Now, again, if you're buying puts, you can go, I think the price will fall. So if you think the price is full, you're definitely not buying a call, you're buying a put. You're buying the right to sell because you think you can sell it here and then buy it lower when the actual price is lower. So select target price below the current price, let's say 98,000, buying a put. You can see the break-even price 103, 102 here. Do you think that will happen? Do you think by the expiry of the option, the price will get either that or even lower? If it does, buy the option. If you don't think you can get there in that time, then there's no point buying the option at all. We just looked at buying options, which means spending cash to be able to do something in the future. The other side of that is that you can write options as well, which means you can sell people the option to do things with your money in the future. Right, so remember, calls and puts are the only thing we can do. Calls are the right to buy, puts are the right to sell. And so instead of buying that from people, we can give them the option to do it. The reason why you do this is because when you write options, you receive that premium. So if you have assets, you can essentially write these options out and try to earn some options premiums around the edges of your money. However, the downside of that is that if they call the option, that means they won the bet essentially, right? Because they're calling the option, which means they're making money, which means you potentially are losing out on some money versus not going to that option. So there's some pros and cons here, but it's up to the individual. If you're looking to do something anyway in the future, then earning some options premiums may be a good bonus for what you'd want to do. So again, calls and puts. This time, what we're going to do, instead of buying the right to buy in the future, we're actually going to sell someone else the right to do that with their assets. In order to give someone the right to buy Bitcoin from us in the future, we need Bitcoin, right? You can't give someone the right to buy Bitcoin in the future from you if you don't have it. So that's why Bitcoin is here in the big one, right? Because you need Bitcoin initially. And what you're doing here is, it's known as a covered call strategy because it's covered because you own the Bitcoin. You're saying, you can pay me money to buy my Bitcoin at a higher price in the future. I'll receive those premiums. If the Bitcoin price doesn't rise, I keep the Bitcoin and I keep the premiums. If the Bitcoin price does rise, then I'm going to have to sell you my Bitcoin. And that's obviously a downside for me because they called the option, which means the price is even higher than the option's price, right? So I miss out on some of that upside. So a covered call strategy earns premiums, earns cash, but potentially limits the upside that you can get from the Bitcoin price rising. So it depends what you want to do. There is a risk here that if you write a call, that you will have to sell your Bitcoin and the Bitcoin price will be higher than you have to sell it at, and then you'll be in cash. Now, if you're looking to sell Bitcoin anyway, then it may not be a terrible thing because you're like, well, I'm just looking to sell the Bitcoin anyway. And yeah, I got called on it and I earned some cash. It depends, right? Because if they call it, you would have been better just waiting. So you don't know. But that's a covered call strategy where you're selling someone the right to buy your Bitcoin in the future at a certain price and receiving the premium. So again, let's say Bitcoin price 100,000. What we're doing now is writing the call. So we actually receive this premium here. And the options expiry price is 101. If it's 102, then we lost out because if we had waited, we could just sell it at 102,000. But we're not going to sell at 102. We're selling at 101, which is fine. So we sell that Bitcoin and we sell it at 101,000 and we keep the premium. So what we get if the price is 102,000 is we actually sell the Bitcoin for $101,100. That's what we get. If the price expires below 101, so if the price is still 100, then we keep the Bitcoin and we keep the $100. So what you'll find in simple options trading on crypto platforms is that this will be called dual asset. It will be under the earn platforms in the crypto platforms that I use anyway. It will be like earning what they call an APR or some sort of yield. It's not a yield at all. You're just trading an option and you're earning premiums. But for some reason it's in finance, and as you can see here, dual asset. It's either called dual asset or something like that, very similar. So again, what we're doing is selling the option to buy Bitcoin from us at a higher price. So what you want here is sell high. And you'll notice that I want to subscribe BTC. They only let you subscribe with the asset because if the option gets called, you have to sell the asset at that price. So for example, I want to sell high. I'm going to subscribe 1 BTC. And you can see the target price is 107,000. The index price is 105,000. That's the price of Bitcoin right now. So what I'm saying is within 1 day, do I think the price is going to get to 107,000? If you think it isn't going to get there, then you can sell this option and receive a premium. Now, you can see on Bybit here that it's given as an APR. It looks very high, right? But this is only 1 day. So you are getting, if you got that same amount of premium each day for a year, it would work out at an APR, like an earnings rate of 41%. But you're only getting it for 1 day, right? So you're actually earning a very small amount in dollar terms, right? And then of course, when that option expires, then you have to go to different options and different options. So you won't be getting 41% on your money. You're getting a very small amount, which is the cash that they pay you for the option, right? Which is the premium that they pay. So it's calculated as an APR, but it's slightly misleading. In any case, do you think that Bitcoin will be moving from 105,000 to 107,000 in 1 day? If you don't, you can sell this option and you can earn some cash. If it does, then you'll have to sell your Bitcoin at that price. And it will be higher than 107 because they'll call the option at 107. Maybe it's 107,500, maybe it's 107,900, maybe it's 110,000. So you missed out on that potential upside. In any case, what you can do is go sell high, right? I want to subscribe this, and then you go and actually execute, and then you're in for that option. You subscribe the BTC because it may be called in the future. So with selling calls, you're basically giving up some potential upside in order to earn premiums and cash for yourself around the edges of the assets that you already own. The other side of this is writing a put, which is giving someone the right to sell us Bitcoin at a lower price. And the reason why they would sell us Bitcoin at a lower price is if the price is even lower than that in the market, right? Because what they're doing is selling the Bitcoin to us here. The price is lower, they can get the difference. So what we're doing here is trying to earn cash right now, and at some point in the future we may get hit with having to buy the Bitcoin, and we will have bought it at a higher price than the traded price in the market. Otherwise they wouldn't be exercising the option, right? So why would you do this? Well, the only reason to write puts is because you're looking to buy Bitcoin anyway, right? And so you're kind of happy to buy Bitcoin, and if the option gets exercised, you're going to be buying Bitcoin. It's not going to be the best price, but it'll probably be a lower price than it is now. And you're trying to get some cash as well in. Writing puts is not the most common of strategies, but as you can see here, what we would do, let's say the price of Bitcoin is 100,000. We're going to give someone the option to buy it from, to sell it to us at 99,000, right? If the price is 98,000, then we would be buying at 99,000. So we would have to spend that money to buy at 99,000. We lost out, right? Because if we had waited, we could just buy it for 98,000. But in any case, we get this premium no matter what. So the unit cost of our Bitcoin would be 98,900 at that point. So you have to be willing to buy the BTC. I think you need to be looking to buy the Bitcoin anyway. And maybe you buy it, maybe not, but you're going to be earning those premiums anyway. Maybe you want to be doing this if you actually don't want to buy the Bitcoin and you think the prices are rising, then you just want to be writing puts because you're going to be earning those premiums, and that the option will never be exercised. But you have to be willing to actually be buying the Bitcoin, and if you do, you'll be buying it at a slightly higher price than you could have if you just waited anyway. So this is buy low. Again, what are we doing? Buy low. We're writing puts, right? So we would be buying lower than the current price, but it's probably lower further from where we're writing the option. So again, I want to subscribe. This time you subscribe in dollars, because if you're writing a put, you have to buy the Bitcoin from them, right? So you have to give them the USDT. So you have to put that up. And as you can see, again, now the target price is lower, right? So the target price is 103, which is underneath the 105. And then 1 day settlement. And you can see the APR, it's worked out as a yearly figure at 45%. But actually, if the option does gets exercised, essentially we get this amount of Bitcoin. But if it doesn't get exercised, you can see how much we earn. So we put $500 in, and what is assessment 1 day? We're earning 62 cents on the $500 we put in. That works out at an APR, if it happened every single day, of 45%. But you have to retrade the contracts every single day, and at some point you might get hit and have the Bitcoin. So there are some risks of writing puts. So if they don't exercise and the price is higher, we just get the money, right? 500 in, we get 500 back plus their premium. If they exercise, then we have to buy their Bitcoin at the price, which is 103,000, and so we get the Bitcoin, but our trading cost comes down a little bit because we're getting their cash as well. For most people, you're probably going to be trading calls. So either that is spending some cash to buy the call, so you think the price is going to rise a lot and you want to take some leverage on that price rise, or the other side, you'll be writing covered calls. So you've got some Bitcoin, you're kind of happy to sell it, and if you sell it, then that's fine, and you're trying to earn some premiums as well on your assets. So with selling calls, you're actually selling volatility, and if you get called, then your upside may be lower, but maybe you want to sell the Bitcoin anyway. Selling calls and buying calls is really what most people will stick to, either taking a bullish bet or just trying to earn some premium off their assets. If you want to trade on Bybit or OKX, I'll leave those links down below. You can trade options on here, and the bonus links, and also the more complex options video, I'll leave that down in the description below. I'm James, this is Managing G. Cheers for watching, and I'll see you in the next one.